Okay, everyone, we are going to take a look at two practice problems in Chapter 8. The first one is going to be 824A, and then the second one is 827A. So let's get started. Now, in this chapter, we primarily looked at what we call internal control, which basically are the processes and procedures the company has in place to ensure that the assets are protected, the company is efficient, employees are following policies, and there's accurate and reliable accounting information. And we talked about the different components that need to be present to have adequate internal controls. Beyond that, then the book got into discussing specific procedures and policies that should be in place to protect the company overall. Then they focused on cash. So in 824A, we're going to look at a couple scenarios, and we're going to identify the missing internal control characteristic, identify the possible problem caused by each control weakness, and then propose a solution. So the first one, Upside Down Applications, develops custom programs to customers' specifications. Recently, development of a new program stopped while the programmers redesigned Upside Down's accounting system. Upside Down's accounting could have performed this task. Well, this is a problem with assignment of responsibilities. The possible problem that could result are lost sales due to delay of product development. The solution, assign the company's accountants to redesign the accounting system. Assign programmers to product development only. And B, Norma Rattler has been your trusted employee for 24 years. She performs all cash handling and accounting duties. It's funny, I'm just starting to read through this and I'm thinking about an example I always give in my regular traditional classes of this happening in Northeast PA. This is very common occurrence, and this is why. Norma, well, they give cash control to one person. Norma just purchased a new luxury car and a new home in an expensive suburb. As owner of the company, you wonder how she can afford these because you only pay her $30,000 a year and she has no other source of outside income. What's the problem? Norma has too much control over the cash, so there's a problem with separation of duties. She could have stolen it. You just don't assume it. She may have inherited money or something, but you want to be aware of that. Keep accounting and cash handling duties separate. So whoever is actually handling the cash should not be making journal entries or creating the bank reconciliation. In C, Izzy Hardwoods, a private company, falsified sales and inventory figures in order to get an important loan. The loan went through, but Izzy later went bankrupt and could not repay the bank. An audit would have identified these falsified figures. So we have unreliable financial statements and lost credibility. The solution, and usually banks require this, have an external audit to reduce the risk of false financial statements. D, the office supply company where Pet Grooming Goods purchases sales receipts recently notified Pet Grooming Goods that its documents were not pre-numbered. Howard Mustrow, the owner, replied that he never uses receipt numbers. Ouch, documents. No, we always use pre-numbered documents. And not ones you write in yourself. They're already stamped with a number. This could lead to theft of cash and inefficiency because you're not accounting. If you don't have pre-numbered documents, how do you know you have all of your sales recorded properly, right? So we want to use pre-numbered documents, definitely. Discount stores such as Costco make most of their sales in cash with the remaining in credit card sales. To reduce expenses, one store manager ceases purchasing Fidelity Bonds on the cashiers. Now, they talked about Fidelity Bonds. You also may hear it referred to as the employee is bonded. A Fidelity Bond protects the company if the employee should steal cash or another asset. And you request an insurance company to provide a Fidelity Bond on a company. The insurance company will then do a complete background check on that employee to see if they're insurable. So if that employee did commit any kind of fraud that is documented, it would be identified then, and the insurance company would let the employer know right up front, we can't insure this person, they've stolen before. So if the employee is insurable, then they'll provide an insurance policy, a Fidelity Bond, for a certain dollar amount. So if that employee ever does steal up to that dollar amount, it would be reimbursed by the insurance company. So you want to keep those employees bonded. In F, Cornelius Corndogs keeps all cash receipts in an empty box for a week. Oh gosh, because the owner likes to go to the bank on Tuesdays when Joanne is working. I love these. Don't leave cash laying around. Cash is not traceable. You can't prove that's your cash. Some companies deposit cash 2-3 times a day, depending on how much cash that's coming in. It could be a busy time of the year, but at least once a day. So the bank account as a control device or competent, reliable, and ethical personnel are the issue here. The internal control characteristic, which is missing, the theft of cash is the possible result, and we deposit to a bank account daily so that we could utilize the bank controls. That's why we have a checking account, to get our cash off of our site and into an independent, secure location. Okay, so those were some great reviews of that first major area of our chapter. So if you're struggling with anything with the internal controls, make sure that you post those questions in the discussion boards. As you're going through the rest of the semester, we're going to be talking about other assets, and the book will be pointing out to you typical types of internal controls over those other types of assets. But cash is the one we really, really protect because that's the most easily stolen. So that's why we have a whole chapter on talking about it. Speaking of internal controls over cash, let's take a look at our problem 827A now. In problem 827A, we are going to complete a bank reconciliation, or you might refer to it as balancing your checkbook. In accounting, we call it the bank reconciliation. And think about this. When we open up a checking account, we are taking our money to an independent area, a bank. The bank records all the information that they're aware of in our checking account. So they record all deposits and all payments or disbursements that they're aware of. And they report that to us every month on a bank statement. So on page 471, there is the bank's accounting of our money. We also keep track of the transactions that affect our checking account in our cash T account. So we keep track of our checking account. The bank keeps track of our checking account. What we do at the end of every month, and this is a life lesson here, is we make sure and verify what the correct balance is of our checking account. Now, if the bank knows everything it should about our checkbook, and we know everything that the bank knows about our checkbook and have recorded it, that means we have a perfect accounting of our checkbook. The balance on the bank statement should agree to the balance in our checkbook. But sometimes the bank doesn't know everything about our checkbook. There's missing items during the month. Sometimes we don't know everything that the bank did to our checkbook until we get the bank statement. So at the end of the month, when we receive our bank statement, we go through a reconciliation process where we identify the missing items in each area and then recalculate our balance, saying, well, if we did know about these missing items, what would have been our balance on the bank statement? What would have been our balance in our checkbook? So that's what this process is doing. Once you complete the reconciliation, your bank statement balance, your adjusted bank statement balance should equal your adjusted checkbook balance. Adjusted being the balance you end up with after you've identified the missing items in each location and added or subtracted them to their previous balance. So you could see the answer right in front of you, but that's what we're doing here. So we have to then reconcile the bank statement balance, and you could do that first or second, it doesn't matter. And then we have to reconcile whatever the other item is. In this case, we're going to do the bank statement balance first, then we're going to do our checkbook balance. Now, you could see listed on our bank reconciliation, we have a column that says bank. So that's where we're going to reconcile the bank statement balance. We always start with the ending balance from the month. That's what we want to prove. So according to our bank statement on December 31st, $18,955 was the balance of our checking account, according to their records. Up above our bank statement is detailed information about the cash receipts the company recorded in the T account and the cash payments. And then right below those transactions, it says the cash account shows a balance of $17,450. So what that's saying is our T account cash back at the company says $17,450. Now, if there was nothing missing between these two independent record keepers, those balances should agree. When they don't agree, now we have to actively look for missing items. So we're going to ignore the book side for now over here. I don't know if I could we're going to ignore that side. What we're going to do is focus on what I've highlighted, the bank side. Let's first see, did the bank have every transaction recorded on the bank statement that we have in our checkbook? And obviously you could see from the answer key, it doesn't. But what we're doing here is going from our checkbook data up on the top and verifying that the items, whether they be deposits or payments, are on the checkbook. If they're on the bank statement. If they're in our checkbook and our bank statement, they're not missing. We don't have to worry about doing anything with those items. It's the items that missing that we need to focus on here. So if you start on the December 4th deposit, $42.40, and go down to the bank statement. Now it says it's deposited on December 5th. That's okay. Is the dollar amount there? Yes. So that deposit is in our checkbook and on the bank statement. The $550 deposit in our checkbook, that is also on the bank statement. The $600 deposit in our checkbook, that is on the bank statement. So I'm going from that top information down to the bank statement. The $1,900 deposit, is that on the bank statement? Yes, it is. The December 31st deposit of $1,860, is that on the bank statement? No, it's missing. Okay, then we need to add it. And that's what we're doing. I'll highlight it right here. So that deposit is in our checkbook, but is not on the bank statement yet. And we call those deposits that are missing deposits in transit. And it's usually because of the timing of the deposit that it does not appear on our bank statement. It doesn't mean it's a bad deposit or it's a fictitious one. It just means we might have taken the bank deposit after the business transaction hour. Meaning, if you ever go to the bank, you'll see a little sign. Transactions after 3 p.m. will be deposited on the next business day. So this will be a deposit, but on January 1's bank statement. It should have been there. It isn't. We do the same thing now with any payments out of our checkbook. So above, we could see there's a check number, 1416 for $810. Is that on the bank statement as being cashed? It is. So go below. You could see the verification there. So verify check number and dollar amount. Check 1417 for $180. Yep, that is there. It's been cashed. 1418 for $630. That has also been cashed through the bank. Check 1419 for $1390. Oh, it's cashed, but for a different dollar amount. And if you look down in Part D, it says the correct amount of check number 1419 was $1,930. So the bank did deduct the proper amount. So we have an issue on our end. We'll correct that in a few minutes. For now, as far as we're concerned, that check has been cashed. Check 1420 for 1490. That is not on the bank statement as being cashed, so it's missing. So we need to subtract it. What would have been the balance if that was cashed? Checks that have not been cashed yet through the bank and are not on the bank statement are called outstanding checks. So we list each one. And as you can see, check 1421 for $700 has not been run through the bank yet. It would have been on the bank statement if it was cashed. And check 1422 for $600. Same deal, has not been cashed yet, will not be on the bank statement. So those three checks, we don't say, oh, good, we have that money available. No, we have to act like that money's gone. It's just a timing issue. The people we wrote the checks out to did not cash them yet. Doesn't mean they're never going to. We don't know when they will. So we have to act like that money is gone. Subtract those outstanding checks, and you get an adjusted bank balance of $18,025. What that's saying is if all of the missing items, the 1860 and these outstanding checks, were on the bank statement, our bank statement balance would have been $18,025. So that is your adjusted bank statement balance. Now, if there's nothing missing from our checkbook or no errors in our checkbook, then the book balance would agree with the adjusted bank balance, but they still don't agree. And we don't go, oh, they're only off $600, we're cool. No, we need to figure out why. So now we're going to, on this side of the bank statement, or the bank reconciliation, we're going to identify items that are on our bank statement but have not been recorded in our checkbook yet. Because sometimes that happens. And you could see there's quite a few items here. But how do we find these items? We start with our bank statement and do the reverse. We go back to our checkbook. Now, if you're saying, I already ticked off a lot of stuff here that I know is in both places. Well, that's fine. Look for the items that aren't ticked off yet. But I'm going to go through each one. Going to the bank statement, December 1st, there's an EFT receipt, an electronic funds transfer receipt of $350. Looking up into my checkbook, it is not recorded there. So it's missing from that $17,450 balance. In Part A below, it says the EFT credit, which is a deposit, was a receipt of rent. So I'm going to add that item because it's missing. Now, my December 5th deposit from my bank statement is in the checkbook. We already verified that. $42.40. Go back up. The $550 on the bank statement, that's also in the checkbook above. The $600 on the bank statement is also in the checkbook above, and the $1,900 is in the checkbook. But is the $1,400 bank collection? No, and that's what BC stands for. So we must add that. And when they tell us in Part C, the $1,400 bank collection was for a note receivable. So what happened here was somebody owed us money on a loan we gave them. They went to our bank and they requested that the money be deposited right into our checking account. So they bypassed us and we didn't know about it. We found out that they deposited that money when we received our bank statement. Now when we know it's there, we could record it. But it's during this bank reconciliation process where we identify it. So we've verified all of the deposits on our bank statement. They were either in our checkbook already or the missing ones are going to be added. Now we're going to go through the same process with our payments. Now they kind of have these listed differently than what I'm going to do, but I'm going to start right with December 8th, that NSF on the bank statement, $400. That is not listed as a payment in our checkbook. Only checks are in our checkbook. And NSF stands for non-sufficient funds. And what happened here is that a customer paid us We thought it was a good deposit. And that's the assumption. We don't debit cash when a check goes through the banking system. We debit cash the day we receive the check. Why? Because legally, you should only be writing checks that will be cashed. Okay, so it's against the law to write a check that won't be honored. So we deposit it, debit our cash account. The bank also deposits it and shows it as a deposit on our bank statement. What happened here, at some point, the customer's bank did not honor this check. So the bank said, oh, well, $400 of that deposit we thought was good isn't. So we got to subtract it now. We've been notified of it now when we see it on the bank statement, so we need to subtract that amount out of our checking account as well. So we thought it was a good deposit. It isn't, so subtract it back out. Check number 1416 for A10. That is in our checkbook at the correct amount. The EFT 225 is not in our checkbook above. Like we said, only checks are deducted out of our normal checkbook. It tells us in Part A, the EFT debit was an insurance payment. Okay, so we should have deducted $225 out of our T account cash, our checkbook, but whoops, we didn't know about it, or we forgot about it. Well, now we've identified it, we could deduct it. Check 1417 for 180 is in our checkbook at the proper amount. Check 1418 for 630 is also in our checkbook at the proper amount. Check 1490, properly cashed for 1930. What did we do? We only recorded it as a deduction of $13.90. So we need to deduct the additional difference, which would